It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your cannabis business podcast. Back with us is Morgan Paxhia, founding partner and chief investor at Poseidon Asset Management. Morgan, thanks again for being back on the Talking Hedge.
Thank you for having me back.
Appreciate it. So for those that don't know, Poseidon was founded by siblings Emily and Morgan Paxhia back in 2013, making the first fund one of the longest running dedicated cannabis investment funds. Poseidon team is focused on a diversified strategy covering a range of company stages and industry subsectors across the cannabis capital spectrum. And so looking at historical context, you guys started out as one of the earliest dedicated cannabis investment funds. Can you share some insights to kind of just bring us to a baseline about how the cannabis industry has evolved since then?
Sure. Well, funny enough, Emily was just realizing we passed our 10-year mark for our first EIN. So that just happened this past month. So just to give some context that, 10 years in this industry is, it's been anything but constant. It's just been, if you think back to that October as we were, getting ready to hit the ground running for January 1 with, Colorado's doors opening. And, but at that point, before the first fund opened, just outside capital, there was $0 in adult use legal sales. So, try to picture that, right? And just how we had no idea what the landscape was going to be like, how things were going to evolve, mature, change. No idea. It was just all white space. So just pretty amazing. And we dove right in. So, at that time, it was just really thinking about building out a very diverse kind of strategy, trying to probe a lot of different areas, see how things would work, what was scalable, what were TAMs like, because TAM was not a word that was familiar in cannabis yet. And and so just over time, we just slowly were focused on certain markets, early on. And then because that was before even the term MSO, the multi-state operator acronym was around. And this was before Canada was even legal, right? It had a pretty great medical market. We were very early in Canada too. So, now today we have something like a $30 billion industry. We've had no federal reform. If anything, it's been, constant federal headwinds. But we soldier on. So, one thing I would say that's been pretty consistent through cannabis is through this 10 years in cannabis has been those that are dedicated and working hard are grinding through this and pushing for the ultimate idea of change in DC. But everything else, what these state markets look like, what brands look like. I mean, if you think about what the early day pre-roll looks like versus today, it's evolved tremendously. You think about the sophistication in retail, from the early days of paper bags, stapled with business cards on them to today where we have these, enterprise technology solutions and data analytics and, AI is making its way in the space. So it's been one heck of a journey over the last 10 years.
What about valuations? Because back in the day, like right now, you could have a football field analysis and take your pick from a half a dozen metrics and go about your way. But back then, 10 years ago, it was like a million years, right? So you had guys chiseling in stone using an abacus and all of all of that. So did you just take smoke signals and convert those into dollar signs, or how did valuations work back then?
Ooh. It was things were low priced, low valuations, because if you think 10 years ago, we were objectively the only ones.
Well,
right?
First off, is everyone making revenue? Because otherwise you could just take a discounted cash flow model no matter what. But back then, was everyone making revenue? And if not, then again, how do you put a price tag on that?
So interestingly, back then, California operators were profitable businesses and they were doing 10, 20 million in revenue. It was before California screwed it all up with these, the regulations and the taxation. It has absolutely destroyed a lot of profit in these businesses. But you can have a profitable business on $10 million. So you just couldn't own equity. There was no equity back then. So we started working with operators on the debt side, and we were doing high interest rate loans for expansion capital. And it was a great way for us to learn about these businesses, learn about, margin profiles, CapEx budgets, all this stuff that, wasn't available in every other market. We were right there in the very early days. So that was very helpful for us to learn about the profitability of operating businesses in California. Again, it's very sad to see that go away. You can't make money on $10 million is kind of crazy if you think about it in almost every other sector. But that's kind of the situation in California. And that was before price compression. Pricing in California used to also be pretty stable. You'd have the seasonal fluctuations with the outdoor crop hitting the market, and until that would clear through. And but it was a pretty narrow band. That would just, and it was, and you could underwrite it. So so we did have that. It was really when you were starting to get into these newer markets, the east of the Mississippi markets, where valuations started getting pretty wonky because there was such a high value placed on just a paper license. But again, because if you were able to get open back then in some of these early markets, some of the numbers you could put up were just monstrous. And it still happens today, right? I mean, New Jersey, there's like the Curaleaf door that does a 60 million run rate. There's the Ascend door, I think something similar-ish, right? Or they had the one in Illinois. So there are still some big doors and big numbers, but yeah, there's definitely been a big learning process. Now we have public companies, so we have public comps, we have M&A comps. There's just so much more knowledge about the space. But back then, you're right, it was tough, and trying to guess. It was really because it was a guessing game in a lot of these newer markets. We tried to build that off of our experience again, really trying to base in California. That's why we actually started the firm in California. I was on the East Coast. Emily was in San Francisco, but I moved out. My wife and I moved out to, really immerse ourselves in that market.
So we do have public markets right now, and yet things aren't really working in individual equities. We've mentioned that before, where it kind of just goes with the flow. It's been challenging.
Mm-hmm.
And so I'm guessing that was a huge part of why you decided to shut down the Advisor Shares Dynamic Cannabis ETF, the ticker symbol PSDN. But maybe you can explain on what some of those factors that led to that decision.
Yep. Yeah, it was, we are not bullish still on federal reform. We don't see this Congress being able to do anything with safer banking. I've been pretty consistent in saying minimally optimistic or just not, or like as close to zero probability as possible. And not that we even think safer banking really does much for most businesses. I think the biggest impact of safer banking was the recent addition of clarifying credit and debit processing, but we don't know if that would actually happen, right? Because cannabis, even if we get to this rescheduling to Schedule 3, it's still federally illegal. So Visa, MasterCard might still sit on the sidelines. And so it might not actually open up this like panacea of this increased basket size. And that to me is like where a lot of the potential growth function of safer banking comes from. It's definitely a perception bump, no doubt, because there's a lot of capital on the sidelines that wants the action. They're sick of the talk because we just keep hearing talk and we don't see the action. But I do see a lot of capital is more excited about Schedule 3. But guess what? We called the shutdown of PSDN. What was it? 2 weeks before the HHS came out. So talk about a gut punch for us. But we still got to see that happen. And so we just were not seeing the flows in the space. And as a result, we were not seeing institutional capital coming in. So the sector was still highly correlated. Very low quality companies would move, exponentially more than the high quality companies or the higher quality companies. It just didn't seem like a very good market to try to continue to manage through. And without the flows to support it, it was a cost center for us. And then you layer in. So we had all this industry challenges that we were trying to manage through, and then you layer in all the macro that we were seeing. With the tightening of monetary and fiscal policy. Well, not fiscal yet, but tightening of monetary policy, the raising of interest rates. What could that be for the consumer and what that means? And just felt like a lot of short-term headwinds. We were still bullish on cannabis, especially high-quality companies. But we were just feeling like there was a lot of macro pressures that were going to continue to be a challenge. And look what's happened subsequent to the HHS news. stocks rallied massively in our sector, was like what, up 100%, I'd say, kind of as in an aggregate. And we're peeling that back day by day by day by day. And it's because nothing has changed. So these companies are still faced with 280E. They're still faced with no federal change. There's been a bunch of chatter, but we need the DEA to do follow suit, and we need clarity on that to really change how these businesses can be. So in the meantime, we still have companies that are, a lot of companies, unfortunately, that are over leveraged and overtaxed. And so we still see a lot of, stress for, the lower quality businesses. It's great for the higher quality businesses, but, point is we're still going through a cycle, and so we just thought it was in the best interest of the shareholders, including ourselves, right? I personally owned quite a bit. And, so that it was very unfortunate. It was a tough call, but we ultimately think it was the right call.
So it sounds like you're not going to make any decisions based on the potential of federal legalization. You're going to assume that it's not happening when you make your investment decisions, and that's not going to change until it actually happens, right? You're going to make moves on the news, like a lot of these stocks do. What was one of the main takeaways? Because I would imagine you had your spidey senses honed in on that ETF and the news and the markets and the way things moved more than most. What was the main takeaway, having looked at that to the degree you did? I'm assuming you wouldn't do it again. Maybe it's too early.
Yeah.
But what was some of the main takeaways from the experience that you had?
I love what we do on the private side with our private funds, and one of which is a hedge fund that can still participate in public companies. I think it is still as a young industry, and where possible, there's select public companies that make a lot of sense long term potentially, but there's a lot of other types of financing vehicles, structured financing, that are also great ways to participate. And when we had originally launched PSDN, it was this idea that we had many years ago about the democratization and availability for anyone to participate. And we thought, with our experience and brand name, that it would be of value to a broader audience, but it didn't work out so much. Like we tried to build a high quality portfolio. We think, even to the final days of it, it was a very well positioned portfolio. With our weightings and everything, it was just obviously in the very short term, it looked like we may have missed out a little bit. But at the same time, I just, the same kind of book is stuff we still look at doing privately, and look to do more of that. Honestly, we're looking at, as capital does want to come back to the space, that we would be a firm to be called upon for, participating on the private side, because there's plenty of work to be done. I mean, you look at the industry nationwide, and you think about the biggest companies in the space have had to be mostly in neutral for cash preservation, and having to reduce their costs to get to a place where they can survive. There's very few that are in gear. There's like the TerraSens of the world, Ascend, GTI, but most are stuck in neutral because they're just trying to get their balance sheets in order, get their P&Ls in order. But as they start to reaccelerate growth, vis-a-vis, you take Schedule 3, and the cash flow generation of these businesses allows them to all of a sudden crank up CapEx budgets again. They can start hiring again. We think that can bring in new capital via private equity, which then can mean more M&A transactions, means more hiring. The ancillary companies start thriving again. Like the whole sector just lights up, just because of that significant potential shift of overtaxation to being treated like a normal corporate participant in the American economy. So those are all great things that we see on the horizon, but it's that bridge between now and then, that we're just trying to be very mindful of. And it was really unfortunate for the time we launched. If you think about when we launched ETF, a lot of people were like, "Oh yeah, that's great. The market's already down a bunch," and then the sector went on to go down another 80%. So just a hell of a drawdown sector wide. And there's been a lot of discourse around what are the drivers of that, and there are some structural inputs, I would say, around CSE dynamics. But if the CSE wasn't open to the US operators, we wouldn't have multi-state operators as we do today, you know? So there's like a little bit of a, you know, as Emily always says, what is it? What nurtures you also destroys you kind of thing, I think is how she says it. And I think that's the saying. But at the same time, these companies, you know, when you think about the drawdown we went through, there were also some very different market dynamics that happened, right? There was a massive slowdown. The capital markets froze for us, as I mentioned. So all these companies had to go to neutral. So the growth left the space. You know, there was a lot of perception implications around that. So, you know, with massive price declines. So, you know, we've really been through a lot in the last 2.5, 3 years as a sector, and there's healing to go with that. I mean, if you think about the correlation to like the Nasdaq bubble and the subsequent burst, it took years for, you know, tech stocks to become cool again, right? I mean, you think about, I remember, you know, investing in 2002, 2003, 2000, you know, through 2000, even 8, you know, there was very few companies in the tech world that people wanted to talk about at all. It was like Amazon and Apple, right? People, if you think about like Microsoft, no one even cared to talk about Microsoft until just a few years ago. I think it was like a $20 stock for years. So anyway, point is like, you know, the healing pour on the backside of a bubble burst like that, it's a process.
Yeah, and I'm wondering with you said democratization and getting people to that wouldn't otherwise have access to it. So I'd like to say, you know, just because you were early doesn't mean you're wrong, but financially it probably doesn't equate. Um, but having said that, you know, you did try to give people access. So when I was managing a
Mm-hmm.
$650 million fund at Capital One, I saw Goldman Sachs 5 years in a row, never lost a single trade, single day losing. And it
Mm-hmm.
bugged me. That's not fair. It's not equitable. And so I finally met my business partner who was running an ML and AI hedge fund. And so bringing Wall Street technology to Main Street, it was a battle because I saw it as like this tool that wasn't really fair. But hey, if we can bring it to the masses and everyone can use it, then why not?
Mm-hmm.
So that's what I'm trying to do. And I'm wondering what your take is on that. So with AI now at our fingertips with ChatGPT, it's literally an app, the Open AI app that you can use. I got some cheesy slogans that you're probably not going to want to use for Poseidon, like we're the weed whisperers. ChatGPT also came up with another slogan for you guys that said, "We're making waves in the cannabis industry." And then
Ooh.
this is the worst one though. Our ROI reef of investments is unbelievable.
Oh man,
Like, yeah, you're not. Yeah,
it's scary how
comedians aren't gonna. They're not worried about their jobs being taken away anytime soon. But what role do you
but quite
think?
punny.
Yeah, yeah, it's not bad. It's not bad. It's got some good dad jokes in there. What
Yeah.
role do you think AI and technology has at this point?
Oh, I mean, one of our companies is already, you know, getting, you know, pretty deep into there's not deep into the weeds on it. And they're already starting to roll out some products around it, which is super exciting. I don't know if you're, you know, staying close with the headset, you know, roadmap, but you know, they've got some new functions coming out that are AI driven around some of their brand analytics, which is super cool. Um, and yeah, I mean, I think retail is one of the areas of our industry that we're really, you know, interested in. You know, we're still deploying capital out of our third fund, venture fund, and with a heavy emphasis on retail. We just see there's a lot of same store sales growth opportunities via optimization. AI is certainly a part of it. We do think that, you know, just doors in the box are lacking. You know, there's just more to go. So, you know, we just think there's, yeah, it's a really interesting time, and you know, these tools and you know, more sophistication around that will only help drive again more dollars, and more dollars against fixed costs. Guess what that means? More profit,
Mhm.
right? And so, so we just see that as a really interesting part of our space. Even with you know, some of the price compression cycles that you go through when you have arguably a commodity product for the most part, because there's only so many brands that truly have pricing capability, which is true in other, you know, obviously in other commodity like markets. But in our space, I mean, there still is a lot of brand volatility, right? So the retail is an area that we think is very interesting, but having those kind of AI tools, and that's just one area that comes to mind from that question. I think, then you start looking at some of our other technology companies that are working on the grow side, like Atavi, which is a young company of ours in the Garden Fund. They're using AI and trying to help with grow be better. Trying to mitigate issues early, so that they can have more consistency, higher quality production. And obviously that's phenomenal. As mentioning about the price volatility or price compression, those that don't have crop failure have certainly a higher probability of success than those that have crop failure in declining prices, right? Because it's just crushing. So yeah, I mean, technology is certainly a play to help that. I think overall, we are pretty well situated with most tech in the space. So any new tech really truly has to be disruptive. If it's just additive, it's dilutive, which I know is kind of a funny saying, but because capital still is so scarce, I believe that. So we don't need another point of sale company, right? We don't need another HCM company. We don't need another data analytics company. It's got to be something that's truly not present, that is needed, because these operators themselves don't want to bear another cost. They don't want to bear another username and password and something else they got to pay for every month if it's not truly something that they need for their business. And AI can play in that space, right? Because AI just helps with that kind of efficiency and growth.
So I do want to ask you about the potential for rescheduling. I know we're not holding our breath. We're not going to wait for it, but it is interesting to see kind of like that 100% pop that you mentioned earlier on equities. So when looking at some of the valuations or multiples, rather, the enterprise value to EBITDA multiple ratio that indicates the market value for the company's earnings before interest, taxes, depreciation, amortization, that rose from 5.7x to 7.9x in just a week, which is fairly significant. So that means that investors are willing to pay almost 40% more for the company's earnings after the announcement. Then we look at the market to book ratio that compares the company's market value to book value or net assets. That's a 63% increase that happened after the rescheduling news came out, where it was at 0.8x, went up to 1.3x, suggesting that the market's now valuing those companies at a premium compared to their assets just because of the potential for rescheduling. So in the historical context, that 1 week, in just 1 week, that's the biggest jump in over 3 years. So kind of underscoring the magnitude of the market's reaction to potential rescheduling announcement. Wondering if that's FOMO, is that a systematic underpricing across the board of these valuations? I know what your thoughts are on federal legalization or rescheduling that might not happen, might not impact companies, but the perceived value, or at least from this, is showing me that could change significantly. What are your projections?
Well, I would go with all of the above. There was, if you think about where the market was before that announcement, where it had fallen to, right? To your point of like, it got to just, very, very low valuation to EBITDA. Our friends of ours at, I don't know if you've heard of Excelsior Equities. They're a newer firm that's, entered the space. They've done some initial coverage. I think GTI Village Farms are some of their two initial pieces that they're doing coverage on. But they are not only talking about EBITDA, but EBITDA, which is earnings before interest, depreciation, and amortization. So they strip the T out to try to bring it to a more, apples to apples with other industries. And so those, as a consequence, if you think about that, then that means the multiples are higher, right? Because if you don't get the benefit of the, because EBITDA could be a little bit misleading because of the 280 taxes. So when you look at it on an EBITDA basis, a bit better. I mean, it's overly punitive in the other direction, but it's much more close to reality than the former. So I like that, kind of analysis. Something we try to talk about is, or trying to impute like an effective tax rate, which we actually used to run on all these multiples, which, if you think about it, it's much closer to EBITDA, maybe like, adding a 20% discount to that, right, would get you in the much more in the ballpark. Anyway, point is, valuations arguably had gotten maybe too low, certainly overshot. What was that? That was a mix of FOMO. That was a mix of short covering because there was a tremendous amount of short. There was, just a flood. And that's unfortunately is like, you can look over time on the stock charts, you can see these pretty significant bumps that have come along the way, as it still has been unfortunately a long downtrend. But every time there's like some potential movement, their excitement comes flooding in, and then the subsequent waning when there is not the follow through of the action to actually make the change. So to your point, yeah, it was the biggest jump and biggest multiple expansion, but now look at it just coming right back. So it's as quickly as it went up as it's coming back. I hope we don't go all the way back to where we were. You think that this is potentially more measurable from a probability of change perspective, purely about rescheduling, not at all about safer banking. It's really unfortunate, just as a quick side note, that there are some folks in our industry that keep telling capital to wait for safer banking to then get involved. I truly don't understand that argument, because we cannot and we do not know when the federal government will finally make change around some of these initiatives. And guess what? If we get a rescheduling, and what if we get something like a Cole memo come back into the mix, then what do we really even need safer banking? You know what I mean? So this is kind of my position has been, and our position is really been that something else is going to happen before the federal government, before Congress actually takes the necessary action. And so their action will just be symbolic, because we'll largely have moved beyond them. And that's just kind of how things function anyway, right? I mean, DC is kind of the last to the party when, with how private industry works.
Well, I think it's interesting. You have Safe Harbor Financial that's publicly traded in their cannabis banking. So they're not worried about their banking charter being taken away. So why would you wait?
Right.
That doesn't make any sense. Banking's already out there. It's not, we need interstate commerce more than we need banking. When you look,
Yeah, we need tax reform. We need that. I mean, that's
right.
that's mission critical. Interstate commerce is going to add a whole heck of a new round of volatility in our space, where you're going to have a massive loss of invested capital in a lot of markets, and a lot of job losses, and then jobs repositioned in other markets. You know what I mean? So it's just going to cause a lot of volatility. Potentially, we don't know, right? That's
we need
just
it.
kind
We
of
need
assuming.
additional. Yeah, we need some of that competition though. There's too much trash in the industry, so some of that needs to go away anyways. So when you can bring some good
Totally.
genetics and good growers to show these other people who've been winning cannabis cups that grow trash, that they just need to go away. That's only gonna happen with interstate commerce.
Yeah,
But
you're right.
there is some cultivation and retail that's been selling in the last 4 to 6 weeks. I don't know if it had anything to do with the news, but then behind that, hemp seems to have some acquisition or M&A activity as well, followed by, I think it was media or tech or something. Where do you see the cannabis investment market kind of evolving now that there's been some FOMO added back into it with the reschedule?
Well, right. Well, the mantra follow the flows, and we really haven't seen the flows. I mean, all the flow that has come into like some of the industry ETFs is not institutional largely. It's individuals, or known as retail investors, kind of like the common moniker. So it really hasn't changed the dynamic. I mean, you haven't seen the major operators, at least, are not they've not notably changed any of their behavior, outside of the cannabis was able to get a little bit of capital raised to retire some debt. You saw Trulieve buying back their debt, at 75 cents on the dollar, trying to show a lot of confidence about where their business is going. You saw Curaleaf do a very modest equity raise to satisfy their application for the TSX, which seems like I don't know why it wouldn't go through, but it's not a done deal yet, but it's in process. So there's like little bits of activity happening, but M&A has been very quiet. And from our perspective, we think the industry is, after 2.5, 3 years or whatever, this capital crunch, and has been in this like safe mode, right? And your computer has problems. I don't know if that still exists, but for those of us that remember what what that means, where it's like limited functionality and just kind of like trying to get things back. But I think a big push for us has been getting back to growth and trying to get operators and companies to feel like it's okay to take a little bit of risk. It's been so afraid to take risk, and so to see an M&A cycle, we think there's a lot of opportunity in M&A. But as much as we're bullish on M&A, we're also terrified by it because it can also be a huge capital destroyer. Because when you have financial engineers and not operators, shepherding these things, where you're not really getting the efficiencies, you're not unlocking the growth. Who does that make money for? It makes money for the bankers and the lawyers. It doesn't do anything for the shareholders and doing shareholder creation. So, but we think that it makes sense, that like as you mentioned, there's some that have been, right. TerrAscend has probably been the most on offense this year with not only balance sheet work but also acquisitions. They're very targeted with Maryland. I mean, it's incredible what they've done in a very short amount of time there. I mentioned Ascend as well, as been doing some acquisitions. So there is some happening, and I do think it makes a heck of a lot more sense that they're focusing on individual acquisitions. The idea of blockbuster acquisition, I think it's probably very early for our space for that to be a high probability of success. I think it's very easy for it to be terrible. I mean, the Cresco, Columbia Care, or the Cannabis now, that one was just kind of felt like doomed from the get-go because it was just way too big, way too complicated, with all of the divestitures and everything that they were trying to do. It's unfortunate that True Leaf and Harvest is one that is also kind of a case study of troubled blockbuster deals. So these smaller ones, certainly from the idea of like getting used to taking some risk again and putting some balance sheet at risk for the benefit of your shareholders, we are starting to see some of those elements. To your point, the tech side has been much more in consolidation mode, but most of those are private companies, so they just don't get talked about in the press very much. But we see it in our portfolios. We see about with our colleagues that have venture funds that have been in some of these companies that have been getting consolidated, and we think that is a good thing, right? Because a lot of the tech in our space, you're doing 2 million, 5 million kind of ARR, which is annualized revenue run rate. So they might be doing less than that on an actual revenue dollars. It's kind of a projected look, but these businesses have also had to go to cash flow neutral or cash flow positive. And if you think about the grander scheme of VC, they're not thinking about cash flow neutral or cash flow positive until they are multiple times bigger. So this is kind of forcing a little bit of aggregation maybe earlier, trying to build bigger, more durable businesses. And so those that are able to do it on the tech side could make some really interesting businesses at a more scale, and do so that's with way less invested capital, which is actually good for shareholders. Obviously, if there's lower amount of invested capital to generate a higher exit value, that's great. That's what we're all trying to do. So we are seeing a bit of that. The hemp side is interesting because hemp, I feel like, has been migrating a lot, right? Where there were businesses that were initially trying to do originally trying to do CBD, have now been branching into these alternative cannabinoids, right? The HHCPs or the THCAs or what, all these like more psychoactive like effects, because they're realizing like the consumer is looking for more, and the Farm Bill has kind of given this little bit of cover where they've felt pretty comfortable with expanding into that. So what is it this year? I think is it a $2.8 billion industry in that space out of nowhere. So that's I just see how the market is trying to respond to unmet needs that otherwise we're just not seeing that kind of development or growth on the CBD side. So as a result, maybe we'll see some more consolidation there, but I feel like that market is a little bit of still in its Wild West phase. And there still is a lot of concern or consternation, whatever you want to say about, is that a permanent part of our industry? I don't know. We don't know because, the Farm Bill could get, where is it? It could actually, be modified or, has to get, I don't remember the exact legislative implications, but things could change there. This is kind of my point. And my fear, or our fear, is that the response is to ban it. And I think that is completely against the whole idea of legalization, where we already have all this infrastructure to tax and regulate than to ban it. So why wouldn't you just add, the inclusion of these alternative cannabinoids into the licensed legal market and let the consumer decide, not have, these states just do this banning kind of stuff. But it's just been a very interesting time. I mean, we were just talking about yesterday how the state of California banned Skittles. What the hell are we doing? Like, it's just like nonsense. So anyway, I'm pro business. I'm pro, sensibility. And so just trying to think about what makes more sense.
Yeah. Well, if there's anybody that's pro Poseidon, how can they get a hold of you guys? Where are you guys at if they want to learn a little bit more, check out what you guys are doing?
Oh man, we are busybodies, right? We're on Twitter, or X as it is these days. We're on LinkedIn. We've got our website, Poseidon.partners. Emily's got her kick-ass podcast with Sai called The High Rise, which is great content. I'm doing a podcast in the Twitter Spaces with the Water Tower Research, Jesse Redman and Toby. So we're doing that. So we're out there. We're at the events too. Patrick right now is like in New Jersey there's a New Jersey cannabis event. We were just at Benzinga. So yeah, we're out there in real life, but you can also find us on the internet.
Sounds good. And I'll leave Poseidon's information in the show notes. But with that, I think we're going to have to roll this one up. So I want to thank my guest, Morgan Paxhia, founding partner and chief investor at Poseidon Asset Management. Morgan, thanks again for being on The Talking Hedge.
Thank you.
Appreciate it. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe. Or don't. And I'm out. Cool. Don't forget to smash that like button on your way out and check out these other videos that we've got.